Hi there. So it's Halloween, very exciting in the United States. So should be a fun day. Excited about today's session. Thank you all for joining. Thank you, Ted. Thank you, Carol, for hosting us. And thank you, Jakob, for your efforts in Beijing to help this effort forward.
Yeah,
Yeah, I'm
Halloween,
excited.
people don't know this tradition of trick-or-treating. Kids walk around their neighborhoods in costumes and collect candy. It
Yes.
must be a tradition that's financed by dentists because the kids get these big bags of candy. And I'm where I am on Cape Cod right now. It's an enclave of 16 parcels and homes. There's no trick or treating because it's most people aren't here this time of year. But it's so much fun. I hope your kids have a great time.
Thank you.
And Jakob, I agree. Thank you for getting us organized for today's topic. And Logan, let's get started. One thing I wanted to do was, if I could, show this. And Carol Lee Rafferty mentioned that this is the hot topic, the competition between China and the U.S. and some people put it in terms of conflict over the trade war. I think it's probably broader. But what's interesting about this Economist article is they're making a case that with respect to the trade war, China's doing better. And then as Carol mentioned, this is the topic around the world, APEC, DC, Europe, Trump's visits to Asian countries. So we feel like we're right in line with the big issues, maybe even too much in line, because when we announced this topic last time, um, it just seemed like it was the right thing to do. But now that everybody else is commenting on it, what we tried to figure out is, well, what insights do we have that are maybe missing from other analyses? So that's a little bit of framing. Jakob, maybe you could put up the slide deck.
Yeah, let me just welcome officially everybody to our fourth session. Can't believe it's been free now. And today we'll talk about national strategies for high-tech industries. There'll be a lot about AI, about semiconductors. So, Ted, as you're asked, here we go.
Yeah, so here we are, fourth webinar, cumulative audience somewhere between 2,500 and 3,000. So we're very happy. One question I had for you, Jakob, as people want to give us feedback, what is the best mechanism for doing so?
It's either through YCB or we have an email that I will share in the chat in a few moments that you
Okay,
can write and we will read everything.
good. All right, so next slide. So here we are, Logan and Ted, and mention, with respect to feedback, when we provided the deep dive into the semiconductor industry last time, these were the questions that we tried to answer. And that was the thing that led a lot of people commented and said, well, you got to look at the strategies with respect to that industry and the broader rivalry between China and the US. So what should people do when they encounter these arguments around what each country is doing? So those were the six questions. It turns out that three of the six, I think, carry over to today. And our view is, pardon me, our view is that the semiconductor industry has become, in terms of industries, probably the most important industry globally. And that, as a result, puts that industry in the center of the strategies for China and the US. And so we covered last time demand, the supply chain, and a really interesting question about which firms capture the most value from the progress with respect to semiconductors. So with that, I think we should do an update because things are moving so fast. So Logan, over to you.
Thank you, Ted, and thank you, team. So when we'll discuss the G2 and unpack some strategic positions that they've taken amidst, and as Ted said, there's a lot of noise in the signal. There's a lot of clickbait type of headlines, but let's just frame the opportunity that's before all of us in the AI boom and parse out some key pillars a little bit. The first the first stop I want to hit on is what's happening with the capital deployment or CapEx. Ted and I have been tracking CapEx spend with leading tech firms in relation to how much they're spending on semiconductors via data center buildouts, via GPUs. We quote Wall Street Journal, other news sources, industry analysis, our contacts in industry, et cetera. I'm going to be mostly quoting the Wall Street Journal just because a lot of people have a subscription. They can go and read it and follow up on this. What we've observed is in 2024, the spend really started to accelerate. And these are by no means small sums of money. You're talking about tens of billions of dollars per quarter for each of the leading tech firms. Most of that's related to data center build or scale out involving GPUs. GPUs being the linchpin of everything. What's that all for? Normally, when you see a large capital outlay, it's risky for an operating team or a management team to do this because they're essentially putting their jobs at risk by saying we're going to deploy all this money into data center GPU, and they don't know if it's going to work out. They don't know if the revenues ultimately will reflect in what they're spending, pay it off, etc., which shows you how much one possible promise and potential the AI boom has. But also it's grown into such a large sum of money that you can no longer ignore it. And so governments and countries are getting involved and they're noticing these trends. And we have not seen it stop. In fact, we've seen it accelerate into 2025. And now it's well over 400. We're just quoting the top seven spenders that are US listed. Just those firms alone comprise over $400 billion of CapEx just in 2025 alone. And analysts expect it to accelerate even further into 2026.
Hey, Logan, could you maybe
yes.
comment on Microsoft as an example? Do you have any
So
thoughts
Microsoft as an example,
they've had
yeah.
a
So
big increase.
they've had a large increase. So their cloud Azure is what their cloud name is, their cloud services. They've had double-digit growth. They've enjoyed quite a bit of growth. They've also invested in the private ecosystem with their investments in OpenAI. That's old news, but how is it going is the idea. And so when these firms deploy literally hundreds of billions of dollars of capital, is it going to pay off? We've also tracked a firm like Amazon, for example, with their AWS ecosystem, phenomenal ecosystem. A lot of companies, both public and private, use AWS. They were one of the first to achieve that kind of $10 billion milestone in terms of revenues reflected. And so we just want to set up for the audience how much capital is being deployed just towards this initiative, this growth initiative globally. It's phenomenal.
And
And at the center,
obviously, Logan, this is the top US companies. What do we know about China? Is it opaque? Can we really track the funding from VCs, some of which are government sponsored?
yeah, that's right. So you can look at filings, the ADR listed. So Alibaba has a fantastic cloud business. Tencent has cloud. Baidu has cloud. They've invested in that, not at the scale that the US in aggregate has. So there is some data out there you can pull from public filings. In terms of the VC ecosystem, it seems to be gathering more investment than it has historically, specifically towards AI initiatives. So there's definitely money going around in China as well. At the center of all of these spending decisions are GPUs, so parallel processors, and that has placed NVIDIA on a growth curve like something that we've never seen. Jakob, if you please go to the next slide. So NVIDIA recently this week eclipsed the $5 trillion value mark, which is a valuation of a publicly traded business on the US exchange that's never been witnessed before. And we're going to put that in perspective in a minute about what 5 trillion really looks like in reference to other benchmarks. But
Just
we
a
can also
quick
observe,
comment, Logan. I'm sorry to
yeah, of
interrupt.
course.
What I find interesting is that this rise in NVIDIA's market cap comes at a time when others are also getting big increases in market cap. I mean,
Yes.
AMD was in 2014 was in such financial trouble, and now led by Lisa Su, I mean, it's rocketing up there, and in large part because it's becoming a more effective competitor to NVIDIA. And the same may be true for other US companies like Qualcomm. So despite the emergence of important competitors to NVIDIA at the leading edge, NVIDIA is going up. So we're not close to, I think, the peak in demand and supply responses with respect to these high-end GPUs.
Well said. And Lisa's done a great job turning AMD around. I started covering AMD as a semis analyst in 2015 when it was $2 a share. So I remember those days well. And Lisa runs a great unit. And so will we see NVIDIA become a $10 trillion company? That's an interesting question. Let's look at NVIDIA relative to the rest of the S&P 500, Jakob. This is a slide that Ted and I had in some previous decks just to highlight the steep, the ramp of valuation and market cap change. And also on the left-hand side, you can see the return profile of the Mag 7, what is referred to as Magnificent Seven, colloquially, relative to the rest of the return of the S&P 500 over that time span. And then the right-hand chart, excuse me, you can see NVIDIA in red, the ramp from 2023 into 2025. That's the valuation change. And then Jakob, can you jump up to the previous slide, please? So that's NVIDIA eclipsing the, I think, what is it, the $3 trillion mark. And then look at the middle of the chart, the $3 trillion mark, and then having NVIDIA go from 3 trillion to 4 to 5 in short order is just phenomenal, which tells you a couple things. One, primarily, is the street investor, the investor base, et cetera, has enormous expectations for payoff for the company to grow into that valuation. This is not a cheap play to invest in. And it also forecasts that all of these cloud providers, these tech firms are going to continue to spend into this AI trend. And so what we're trying to do with these slides is frame up the opportunity of how much capital is at stake, how many participants are involved in the broader AI spectrum. Jakob, can you please advance 2 slides? Let's also put 5 trillion in perspective relative to other sectors in the S&P. NVIDIA alone eclipsing the entire S&P 500 industrials, consumer staples, et cetera, is quite incredible. Let's also jump to the private side because, okay, so we see public companies, we see the news and the headlines, we read the financial statements that come out, earnings, but what's happening on the private side? Here's another trend that Ted and I have been tracking. We've brought it up in our 960 class, Economic Analysis of High-Tech Industries. We have seen incredible growth in AI investments on the private side. The US has a rich and deep VC ecosystem. And we've seen capital deployment that's also at unprecedented levels that we've never seen before in the private markets, specifically with AI bets. You look at the unicorn valuations or companies that eclipsed $1 billion in valuation at time of funding. You've seen more of those in AI than ever before. You're seeing that accelerate and continue. AI startups have secured more funding than the rest of the entire ecosystem. Now it's more than half of US venture dollars in 2025 have been specifically for AI investments. Let's also remember
Logan,
that's, yes, Ted.
Let me insert my view. A question that's been raised, and probably everybody who is participating in this webinar has seen this question: are we in an AI bubble? And I'll give you my take, and then Logan, maybe you could add your comments. But my take is what Logan has established is that the AI spends are huge and accelerating. And then secondly, the stock market is saying, bravo, good, we like this. They're rewarding the companies that are spending in terms of expectations around future earnings. So
it's unusual.
If there's an AI bubble, both the firms are wrong and the street is wrong. So I tend not to I tend not to think we are in an AI bubble. Instead, I think what we're in is, as Lisa Su says, the second inning. Forgive the sports analogy, but it's World Series time. The second inning of a 9 inning game.
So early days.
Yeah. So Logan, what do you think? Are we in an AI
Mhm.
bubble?
In my view, right now, my view is that the private market has gotten ahead of itself in some of the valuations for firms that are pre-product. They don't have a product, yet they may have $1 billion valuation. Large public companies, they have lines of business that can support initiatives for longer. They have their balance sheets are stronger. So if you have a company, a private company that was started 8 months ago, that's valued at $1 billion, that has no product and that could be eclipsed by another LLM or some other application almost overnight or within a quarter, that to me seems shakier. You've seen commentary out of leading firms such as Sequoia that talk about how AI investment has gotten a little bit over its skis, meaning it's wobbly, meaning it's maybe toppy, or there's been too many dollars chasing too few deals. So I think private markets look a little bit shakier to me in terms of valuation rather than the public space. And then this chart highlights OpenAI, which is, everybody knows OpenAI. They have over 800 million users. Very few of those paying users, by the way, low single digit percentage. However, this company has become the most valuable private company in the world at this time. So a valuation eclipsing $500 billion. So this is one of the leading firms in the world right now. They also have allied with the U.S. government and different technology firms. Let's jump to the next slide, Jakob. Let's put this in perspective. They've done about 1.5 trillion in aggregate deal value, meaning that when they went to Oracle, they made a multi-hundred billion dollar deal saying Oracle's going to invest this much money with OpenAI, whether that's cash or equity, and over what time span. So each firm in this chart has a different deal and deal terms, obviously, at different times. But what this chart shows, and the reason I really like this chart, is because it shows the news announcement the day of the deal with OpenAI. So when OpenAI does a deal with Oracle or with NVIDIA or AMD, what happened to the stock price? And these are not small firms, by the way, Ted, as you know, these are leading technology firms. But if you look at the change in market cap, market value, just based on that news announcement alone is amazing. And we've never seen anything like this before. And so OpenAI, in what we say in the US, has become a kingmaker, that if you have a deal with OpenAI, you present that in the news, your valuation could change overnight dramatically. And so we've seen behavior like this, and this all coalesces into a lot of attention from the U.S. and the G2, et cetera. Ted, do you have
Logan,
a
do you
comment
want
on
to
this?
comment at all about we mentioned Oracle and
Hmm.
after this pop in Oracle's value, we I think expressed some skepticism. And when you look to the right of the vertical line marking the date of the deal, you see Oracle hasn't solidified those gains. Contrast that with AMD, what happens afterwards. So it seems to me not all these AI deals, open AI deals are alike, but still your major point is AI is a kingmaker, central player, and these announced partnerships generate huge gains for the partner.
Yeah, that's right. It reflects that the street and the investors believe that these deals are real, and it's not just something that's a news headline or something like that. Let's remember that in years past, many companies, more than half the S&P tech firms, would say AI or machine learning on something on their earnings call. The stock wouldn't really react to that because there wasn't line of sight. Now, if you look at AMD, they design GPUs. They are in a duopoly with NVIDIA. And so when OpenAI says we're going to use your GPUs, we're going to use your product, that's, I think, a more convincing argument than saying we'll help Oracle with their cloud services business in a lot of different ways. Maybe is less believable. let's also highlight that that movement in Oracle that day, the announcement was the largest jump in Oracle stock in over 30 years, I think since the 90s, Ted, which is amazing. However, has that excitement faded a little bit? Maybe so. If you don't have a comment, we'll move on to the next slide. I just want to touch on energy use for a little bit. So this is a bit of a lagging statistic, but this shows data center use in terms of all electricity, which is on the right-hand side of the chart, map of the United States, continental US. And then on the left-hand side of the chart, it shows the projection in gigawatts of data center use in the future. The reason why I want this chart, I want to see this chart just in the back of your mind marinating, is what's going to happen to the energy? What's going to happen to the energy use of us as citizens? But quite literally, how are we going to power the data centers? What's China doing? China's outspending the US. They're building more plants, they're building more energy faster than the US can. That's going to dictate some of the policy decisions that both the G2 players are going to take, and that energy conversation is, pardon the clumsy analogy, it's heating up. Ted, you're seeing more of that in the news. It's quite literally where are we going to get the power? So anyway, we're not going to spend a lot of time on that, but I want the audience to remember that the energy conversation is fundamental to the tech and the semis at this time, and will continue to be. And then let's draw some conclusions lastly, and then jump into the next part of the presentation, please. So NVIDIA is central to the semiconductor narrative globally. It's of global interest to many participants. It's also it's important, but it's just one piece. And I think it's more important to highlight that China and the U.S., they both have influence over different, and in what our belief is complementary pillars of the AI ecosystem. U.S. has positions that are leading in hardware semis, obviously NVIDIA, AMD, etc. More LLMs. We have a deep venture ecosystem in the U.S. China has mass scale, Ted. China has mass industrial adoption, implementation, state backing in different ways. You have both are expanding their influence where they can. I'll give you an example. Qualcomm developing its AI chips that are going to hit the market in 2026. We haven't talked about that today. That'll be interesting to talk about in future conversations. Or interesting companies that are not in stealth mode, but are coming to light a little bit. Companies like Substrate that have secured about 100 million investment that do lithography, so the machines that design the chips, challenging ASML that are 1/10 the size and it can be built in the US. That's very exciting. And China's driving adoption. Obviously, there's a mountain of academic research in China with patents and things like that, with leading firms, and China is investing heavily in that. And so they're expanding their influence where they can, which will define the direction of not just the semis, but the AI boom and the umbrella in general. So back to you, Ted. Let's pause, maybe get a couple of questions from the audience, fill in a couple gaps, and then we'll move on.
Thank you, Logan. And Jakob, any questions sort of popping?
Feel free to raise your hand, type in the chat. We can unmute if you can't unmute yourself, or just turn on your camera. If not, feel free to type the questions in the chat as we go on, and we will have a Q&A at the very end of the deck. Ted, I don't see any questions at this time.
Okay. Thank you again, Logan. Let's go to the next topic. So given what Logan has established, that the semiconductor is really central to the rivalry between China and the US, what are the strategies that make sense for those two countries? And the first question we want to address is, can China and the US create their own individual supply chains for semiconductors? What do we mean by that? It's not necessarily all within China and all within the US, but supply chains that don't involve the other and instead rely on other countries where the US or China would feel that they've got a high level of assurance that the supply chain won't break down. And then the second topic is very hot topic. Will China restrict the sales of rare earth elements? And we had predictions about number two, and our predictions are consistent with what just happened. So we'll get to that. And then the third is, what is missing? When you read all these analyses of what China's doing and the US is doing, is there something missing? I think there is. So that'll be the last question. But let's go back to supply chains. And both countries have signaled that they want to move in this direction with their own controlled supply chains. And US policy started with the CHIPS Act, and you get the investments in foundries in the US. US is taking stakes in high-tech companies. Intel is an example. You've also got stakes in quantum computing. And the US has been encouraging companies to manufacture and invest in the US, companies such as TSMC and Samsung. So the US is taking actions that are potentially moving it down this path. And for China, they've been emphasizing technological self-reliance for years. And the fourth, and I'm forgetting the term, but the fourth statement that just was made recently included this emphasis on self-reliance when it comes to technology. Fourth plenum, thank you. And then what I find interesting, and it's a little bit opaque, meaning it's hard for me to understand exactly how it's done. China's making huge VC-style investments through investment funds that are related to the government. So back to the question, will this actually lead to each country having their own supply chains for semiconductors? Our answer is no. Let's go to the next slide. Why do we say no? It's because when we look at the 9 stages of production when it comes to semiconductors, we observe, first of all, there are 9 stages. So getting control over 9 stages is hard. It's complicated, and it's an extremely global supply chain. So raw materials to wafer production, design, the equipment that's used to actually create the semiconductors, the foundries, memory, and purchasers. Assembly and testing, manufacturing services, and then going to the end purchasers. It's a complicated supply chain. And then let's look at where the leading firms are in each of these steps. Look how global this supply chain is if you look at the leading firms. So raw materials, Japan, China, Global Wafers, POPs when we look at the wafer production, look at design. Qualcomm is a good example. They're based in the US. ASML has the equipment for lithography. They may be getting competition from Substrate, a company that Logan mentioned. And then you go to the foundries. Where are the top foundries? And then where do you get the memory software added in? South Korea, and so forth. Assembly, lots of different places. Manufacturing services, lots of different places. The end purchasers are all over the globe. So could they continue to move in this direction? Sure, but it's costly and it would take a lot of time. So to the extent that we are right, and I think Lloyd and I feel pretty confident about this sort of divorce and creating separate supply chains is not going to happen for many years. And to the extent that each country pursues this as an objective, just like divorces, it's going to be costly. It's costly to duplicate steps that another country is better at. And it's just like dual sourcing. Dual sourcing may make sense in some situations, but it's costly. It's costly to have the insurance of a second and third source of supply. So Logan, do you have comments that are reinforcing or maybe divergent from what I just said? Our answer is no.
Yeah, well, supportive of what you said, Ted. I mean, each of these, if you think about the 9 steps that when we're summarizing, obviously there's a lot more nuance to this. However, these main stages at each technological handoff that you see, there's a tremendous amount of intellectual and human capital and specialization that goes into this. And so it's easy enough to say, okay, we'll go build you a race car out in the desert of Arizona that can kind of do all this stuff, and the machines that build the machines, where are you going to get the individuals that are able to do this? And so what we in support of what's Ted's commenting on is that it's too global, it's too complicated to just dismantle, and also starting over from the beginning, embryonically shielding these industries and growing them up is tremendously capital intensive, would take a tremendous amount of time. But not only that, the industry is moving so quickly, and Ted and I say this in almost every lecture, the speed and the amplitude of these motions in technology is different than any other industry that you'd analyze. And especially with AI, you're having new LLMs sometimes every week or every 3 months that come out that absolutely dwarf the power or the precision of other models. And so something that's moving that fast, that's that costly, very difficult to disarticulate it and build it back from the ground up, Ted, in our view.
So that's our answer to the first question. The countries will talk about this. They're going to have political motivations to go in this direction, but they're not going to really get anywhere close to separate supply chains. And there are obviously implications of not getting to that. Let's go to the next question, which concerns the rare earth minerals. And the first bullet point here, I mean, I see different percentages. This is a particular source that's cited in the notes, but whatever source you look at, China accounts for a very high share of production and refined production. And this is different, though, from reserves. China, and even if you add in Russia, presumably that you want to couple those, they have less than 20% of the global land mass. And I don't know exactly the distribution of reserves, but I think it's pretty clear that reserves are found in a lot of different countries. US was a leading supplier of rare earths a few decades ago. And so I think it's the case that many countries possess rare earth reserves, but they're not producing them now. Why? It's complex. And another factor that's not listed here is mining rare earth reserves. It involves a lot of cost to the environment. And that's probably why the US has backed off. We'll see whether Australia and other countries ramp up. But China has systematically pursued this position, this leading position with rare earths. Now the question is, what do they do with it? Do they actually get organized and severely restrict rare earth exports? Our answer is no. Again, the answer is no. Why? Let's look at the next slide. So our view is China is positioning itself to control exports. So you would need a license to buy from China. and there would be limits on resale of rare earths for licensees. This had been scheduled to go into effect in about 10 days, but consistent with our expectation, the Xi-Trump meeting this week resulted in a 1-year delay, a 1-year truce. But that still remains, what still remains is a question, might China actually pull the trigger, and by that I mean severely restrict rare earths sometime in the future, after the 1-year delay, the truce is over? And my answer is no. It's not because it wouldn't have a huge effect. It would. It would have a devastating effect on the US, on the EU, and many other countries in Asia, around the world. These rare earth minerals are so central to many high-tech industries and manufacturing of high-tech products. But there's a lesson here, and this is one advantage I hope that I can bring, an insight. There's a lesson from what OPEC did in the 1970s. The OPEC, the Organization of Petroleum Export Countries, including countries like Iran and Iraq and so forth, in the 1970s, they severely restricted oil exports to the West and caused big harm. In the US, there were there were lines to fill up your car or truck with petrol, gas. The 70s was a bad decade for the US economy, in large part because of these restrictions on oil. At the time, we had a president, Jimmy Carter, who sat in the White House and told everybody we were in an energy crisis and we couldn't put the air conditioning on as much as we wanted to, and we couldn't heat our homes as much as we wanted to. So it was a really big deal. Not as big a deal as I think exporting rare earths and severely restricting those. But here's the lesson. OPEC in 1972 had at least 50% of world oil production. Now they're down to 36%. So as soon as a cartel or an individual country embarks on restrictions, it produces both demand and supply responses. And the more time that you have for those, the greater are those adjustments on the demand side and on the supply side. There's not much people could do if China restricted rare earth exports immediately, but within a few years, there would be supply responses. So what interesting fact about where OPEC is and where the US is on fossil fuels, which are the leading countries when it comes to producing fossil fuels? Carbon includes coal, oil, natural gas. Who's the leader? The United States. Who's second? Russia. Who's third? Iran. So if you give these markets enough time, what happens is that the power that you think the OPEC had diminishes over time. If that's the case, and I think it would be the case if China restricted rare earth exports, you would get supply and demand responses. And exactly when you would get significant reduction in Chinese market power, I can't tell you. I'm not an expert on this, but I know it would happen. That's what economics tells us. So now put ourselves in the position of China. What's their best strategy? I think their best strategy is to get organized with export controls and use that status, that power as leverage, but not actually severely restrict rare earth minerals. The other, not only would they lose market power over time, one of the constraints that China faces is they're the best at manufacturing so many different products. EVs, of course, is one. Solar-related products. We'll see what happens with robots. All kinds of consumer goods. China doesn't want to lose markets for their exports. So export licenses, yeah, put them in place. Don't severely restrict rare earth exports, because if you did, you would kill your own export markets to a great extent. There would be retaliation, but even if there weren't, you would have trouble selling as much as you wanted to sell. So our prediction before this week was we're not going to see China really so-called pull the trigger on this. It would be devastating, but it's not in their short run nor in their long run interests. And we're not surprised by the Xi-Trump agreement on a 1-year delay. Logan, comments about this?
To wrap it up, I mean, this was our working hypothesis well before the meeting. And when we analyzed the industry at large and the impact rare earths would have, not just on the manufacturing delays, but also the relationships with other global firms, if China were to do this or pull trigger, as Ted would say, that's not something that the market's going to very easily forget. And Ted referenced what happened with OPEC over the long term. And I think that China, with the maturity and the sophistication they have, is weighing that very carefully, Ted.
Logan, I'm glad you mentioned that. I mean, one of the things, I'm not a China expert. I studied China a little bit in college. Had the great experience of visiting China about 40 times over my career. I'm not an expert, but one thing I figured out is China is patient and they're strategic. Yes. So, and the opposite of reckless. So I think the comments that Logan just made, the maturity of China, the sophistication, should be added in, and I think it's confirmatory. Jakob, anything that I should address based on the chat?
No, go ahead.
Okay, our last topic.
We'd also, sorry, Ted, to interrupt. We encourage the audience to participate. One of the foundations of all of our seminars and the class that Ted and I have taught for years is we love creating new knowledge. There's industry experts that sit in our audiences every single session. Don't be shy. Don't be a stranger. No bad questions for the debate.
Yeah, the question came up, when did I first visit China? I first visited China, it wasn't that early. It was 1993. And at the time, I was at University of Michigan. I was starting an institute that would get the university involved in what were then called transition economies, like Central Europe, Russia, South Africa, India, and of course, China. We set up programs with Western companies that were doing work in China. Cummins Engine, for example, working with Chongqing Automotive Engine Plant, and also with state-owned enterprises like Dongfeng Motors, Second Auto. And so that was 1993, and it was so exciting, just unbelievably exciting and interesting, and the welcome that we got and the engagement that we got was sort of amazing to me. At one point in my Ann Arbor home, I had 4 of the 5 top senior executives from Dongfeng Motor around my our dining table. So I have a lot of fond memories of visits to China. Of course, things have changed. It's not as it's a lot more I'd say the terrain for people from the US is more complicated. Let me just put it that way. All right.
One more question, Ted, if we could entertain,
Yeah.
or we can save it for the end. It's about manufacturing capacities in other regions in Southeast Asia. Do you want to field that now, Ted, or do you want to save that for the end?
There are, but they don't have the capacity that China has. But I think the point that I would make is that remember that's not going to be static. Australia's going to invest more. Will Indonesia, Chile, the US, Canada. I think the picture on capacity outside China is going to change. And I don't think it'll take that long. It's not easy, but 5 years, I think it'll change quite a bit.
Yeah, I agree. I'll just mention that other regions. So if you remember back to the diagram of the 9 stages, you're going to see maturity and evolution in different parts of those 9 stages broaden to different parts of the world. But think to yourself how capital intensive to build something in Japan would be relative to India. That's also going to influence some decisions that are made there. Ted, back to you.
Well, let's turn to the last topic, and we may end quite a bit early. But I do have a bit of a quabble, I guess, with quarrel with some of the analyses of the country's individual strategies. But let's start with a quote from 10 days ago from Fareed Zakaria. For those of you who don't know, Fareed is the host of a program on CNN called Global Public Square. He's a Yale graduate. He was on the board of trustees for Yale. He was involved in the development of the Global Network for Advanced Management. Came and talked a couple times to Yale SOM. So I've gotten to know him, and I think he's really astute. For those of you who don't know about this particular show, Global Public Square, I would recommend it. It's one of the few shows that I record every week. But his quote was, I think, instructive and close to being accurate. He says, the contest with China is structural, a rivalry between two great powers bound by mutual dependence. And I put in italics, mutual dependence. If I were to rephrase that, I would substitute away from mutual dependence, Fareed Zakaria in parentheses there. The contest with China is structural, a rivalry between two great powers who are in a mutually beneficial economic relationship. The idea of mutual dependence seems like, well, you're stuck in a bad marriage. That was Logan's sort of analogy. I think we have to recognize this is a mutually beneficial economic relationship. So how do we see that? What's the evidence? Next slide. Well, China and the US are, of course, the G2. And this chart begins soon after the policy changes associated with Deng Xiaoping, 1990. And you see the combined share of China and the US starting out at about 28% of world GDP. Sidebar, I should note, you can also measure share of world GDP using purchasing power parity, and you get different numbers. But this is based on nominal share in current US dollars. And look what's happened since then. A phenomenal increase in the share of China and the US, the G2 share, And I've done a little bit of research on other G2s. There's nothing like this. To get over 43% of world GDP with two countries, it's an amazing run. Let's look at the next slide just to break it down between the increase for China and the increase for the US. China started out the red line, 1990, at a really low level, but now is over, I don't know, it looks like about 70% of the US. And there was that period around 2020, we've talked about this before, there were a lot of predictions that China would overtake the US. You see that run up, but then China has flattened out. The US share is really quite amazing. And it's increased in absolute terms dramatically over the same time period. So here, that's the evidence of the increase in each country's share and aggregate output. And just to restate, we've not seen anything like this. This is not just any old G2. This is a very special relationship. Logan?
Agreed. I think with China in particular, their ability to manufacture at scale, but also invest in innovation in robotics and manufacturing. We'll talk about that in the summary bullet points a little bit more. But these are two tremendous powers that combined are shaping where the world, the direction of the world is going on so many aspects of technology. So, and which is why also Ted, says that it's an economically beneficial relationship. And that being said, and with the speed that everything's moving, divorce is exceedingly costly and doesn't make sense economically, and it doesn't make sense for the rest of us in the world.
Yeah, so I had the great fortune of going to the University of Chicago, studied economics, and my first year I was taught by 4 Nobel Prize winners, one of whom was Gary Becker. And when I returned to Chicago as dean, ended up co-teaching with Gary Becker for 9 years, Nobel Prize winner. And we actually talked a lot about China. And his point was, I think, important. He said, when you think about the potential pairings between the US and other countries, China and the US are natural partners. They're natural partners. And it's what Logan just mentioned, the manufacturing, the US supplies services, financial services, foreign direct investments. China has become preeminent in manufacturing of many things. So this would not be the case between, for say, Great Britain and France. When you take another pair, would not be the case if we paired up the US and Germany. US and China are natural partners. So let's go to the next slide. So here's my quibble. This is a restatement of what, pardon me, I read about. What objectives does China have? And I won't read these, but manufacturing, obviously, gain leadership of the AI, maximize influence globally. And we talked about the supply chain for semiconductors. Well, what are the things that you hear about the objectives of the US? Let's go to the next slide. Trump says we've got to remain viable in manufacturing, leadership in AI, influence globally, also gain control over semiconductor supply chain. Well, what's the missing objective? Next slide. It's to continue to realize the benefits of this historically successful G2. It's so obvious once you say it, but the analysis that I read, and I think the analyses that you read, miss this fundamental point. And this is why I don't think, going back to the specific questions, I don't think China is going to pull the trigger on rare earths. I don't think the US is going to actually set up their own independent supply chain for semiconductors. Doing so would negate the likelihood of continuing to realize the benefits of this historically successful G2. So Logan, do you have any comments on this before we go to implications and conclusions?
I'll just say that in concomitant with what you're pointing out right now is that yes, there will be an effort to espouse the domestic semiconductor industry in both of the G2 countries, and there will be initiatives to continue to invest in the private side and partner with publicly traded companies. Having those in isolation doesn't make sense on many dimensions, and so them moving together in unison makes more financial sense and economic sense for all parties involved. And yeah, let's jump to the conclusions, Ted, and wrap it
Good.
up.
So to sum up, number one, we should not expect two independent supply chains for semis. We don't expect China to severely restrict rare earth minerals. We've covered the beneficial relationship between US and China. We'd expect continued benefits from cooperation. And we're not surprised by the one-year truce. You might expect China and the US to sort of muddle along. There'll be rivalry, there'll be frictions, but the relationship will continue. The one question, if that's our hypothesis, as many of you know, when Logan and I taught, we would identify hypotheses. And then we would consider alternative hypotheses. Well, number 4 is, I guess, our hypothesis. We expect the countries to continue to cooperate and realize these economic benefits. The alternative hypothesis, which we should, I think, flag and identify and consider, is the nature of those benefits changing? Is there some major change going forward that will prove us wrong? And I think the thing that I would point to, based on the work that Logan and I have done, is AI. AI might be changing the stakes in a way that China and the US individually and together cannot cooperate. If you view AI as so fundamental to the way societies and economies are going to operate in the future, and Neil Shen, who's the founder of Yale Center Beijing, basically told me and the class 6 years ago that's what he expected. If that's the case, then maybe each country will say, we cannot cooperate the way we used to. We can't muddle through, because the competition for AI, for leadership in AI, is so critically important, even to the point of saying existential. A lot of this, I think, this alternative hypothesis depends on how you think about AI. Is it just another tool and innovation that's going to reduce costs? Or is it, with generative AI, something that's more fundamental and is a potential substitute for human intelligence in all ways? So those are, right now we're on number 4. That's our hypothesis. But we have to acknowledge the alternative hypothesis that maybe things will change going into the future because of AI. Logan, last words?
Last words involving number 5. I would say in previous discussions, we have talked about where the value capture lies in AI, and I think that's also going to dictate some of the reaction that we're going to see from the G2. Let me frame that. When we talk about value capture, does the value capture for me, for example, as a ChatGPT or Claude user, for example, from Anthropic, do I realize more value than they're gaining from my use of it? That would be more use to the end user, to me. Or are they capturing the value, the firm, or are there larger players or other players? And so when you think about AI and where it's going, where it's moving, think about in your mind which party is capturing most value. Is it the firms, the tech firms that are creating the LLMs or creating the applications? Is it actually democratized more towards the end user? And so that's going to also illuminate the direction of the discussion. And I just want to tack that on at the end, and we'll talk about that again in the future, I'm sure. But I think we can field questions now, Ted, if there's some questions from the audience to wrap up. What do you think?
Yeah, I think that we can put the slide deck down, and Jakob, will turn over to you. Are there any questions of note?
First of all, for those of you on Zoom, please raise your hand or type your question now. In the meantime, let me read. We've received some questions on WeChat. And Ted, how long will it take for the US to no longer need Chinese rare earths? And perhaps that's a question that goes to the future of the relationship, of the G2 relationship.
Well, I don't know. Will it really come to that point where the US doesn't import from China? I don't see that happening anytime soon. And I see China being willing to export to the US. They may get more control over that, but I don't think they'll turn off exports to the US. So I would say not in the short run, and not in the intermediate run.
We also had
Logan,
one question about bubble. With the rare earths. No, I agree with Ted. I mean, again, for the U.S. to ramp up production, is it possible? Yes. It's more likely they'll invest in other countries that have a better structure for rare earths and have richer deposits, to be honest. Let's turn to the bubble question. That's one that we got pinged with in terms of what's the possibility of a bubble. We did talk about that earlier in the seminar. Let's reframe it maybe in a different way. Yes, the valuations are very high. They're exceedingly high in the private market, in our view, higher than in the public space. However, when you do see what's called a drawdown, or say the bubble bursts, who is impacted the most? Likely the players or the participants that have the weakest hand, meaning that they have the most limited line of sight to realization of either revenues from their spend or ROI, return on investment, from their spend. And I think that's going to hit on the private side, because you have companies that are pre-product that likely are going to be obsolete or may not go anywhere, or by the time they bring their product to market, there's not a market for it, or the market's too niche relative to what they spent standing the company up and growing the business. So I think that's likely where you're going to see the cracks first, in my view. Ted, you might have a comment on that.
Well, what I've been learning is that with these AI models, there's another sort of process that's going to happen, which is to take these models and apply them to specific domains with additional information and data. So when it comes to applications, we have another major kind of domain-specific modeling that needs to be done, will be done, whether it's law firms or particular applications in medicine, healthcare, et cetera, all kinds of specifics. And that's going to take time. And that's one reason why I think the investment's going to continue. Just getting to LLMs is not the end. Getting to particular GPUs is not the end. This is going to be, I think it's a widespread deployment and applications of AI-related technologies. It's going to take a lot of time.
Agreed. Well, maybe back to Carol to thank you for hosting us yet again for another great session. Ted, I feel like this is a productive discussion.
Yeah, I want to underscore what
thank you.
you said. We're so grateful to Yale Center Beijing, and Carol, you and your team are wonderful. We wish you a good weekend, and just want to make sure we express our gratitude.
Thank you so much to Ted, Logan, and Jakob. This could not be more timely, and kind of I don't think it's just the US and China anymore. It's really the entire world has their eyes on this very important relationship. So, I especially want to thank both of you and Logan for waking up so early in California to do this for this audience. And we very much look forward to the future iterations and to getting these important information discussions to an even wider Yale alumni and friends audience around the world.
Thank you, Carol.
I want to say thanks to Logan, thanks to Jakob, and we'll see you next time.
See you next time.
Thank you,
Bye-bye.
everyone.
Happy Halloween.
Thank you.
Ciao.
Bye-bye.